Celsius stock is down 7% on the day at the time of recording this video. The company put out its third quarter earnings results this morning, and the market so far is responding very poorly. This drop means that the stock is now down 69% from its all-time highs. I have also been discussing Celsius recently on my channel, as many of my viewers are interested or invested in the stock, and I have now been asked for my opinion on the most recent earnings. So in today's video, I want to go over Celsius's earnings report and point out all of the highlights that I found. I will also be discussing whether or not I think Celsius stock is now looking cheap today. Before we get into the video though, I generated an AI stock analysis report from Stock Unlock on Celsius. This report goes into Celsius's fundamentals and price today. You can get the report for free by clicking the link in my description. And with that being said, let's now hop into the video. So as always, I went through Celsius's most recent earnings report and the investor presentation to take a look and find all the highlights that I think investors should know. So this is the first screenshot right here, and we can see that retail dollar and unit sales volume grew by 7% year over year in a challenging category period. So Celsius does look like it is selling more volume at retail locations on a year over year basis, but it also seems like the company's growth is significantly slowing down. Continuing on, this says, despite retail sales growth, distributor supply chain optimization in the third quarter adversely affected net revenue by approximately $124 million year over year. Now, to understand what this point is saying, we have to first understand how Celsius recognizes revenue. So what Celsius does is it sells its drinks to distributors like Pepsi. And when Celsius sells its drinks to Pepsi, it recognizes that revenue. Then when Pepsi goes out and sells Celsius drinks, which is becoming a serious tongue twister for me, Celsius does not recognize that revenue. So basically, Celsius records revenue when the distributors order products and Celsius delivers the product, and then those distributors are completely liable for going out and selling all of the drinks. Now, what's recently happened is Pepsi, which is Celsius' #1 customer or distributor, ordered way too much Celsius last year. That is also why Celsius's revenue and all of its cash flows and everything were growing at like 100% year over year, is because Pepsi was ordering so much freaking product. However, Pepsi themselves have said that they oversupplied themselves on Celsius drinks, and now they are working through that inventory before they order more Celsius drinks and inventory to ultimately sell. Now, while Pepsi is not ordering Celsius drinks, obviously Celsius is going to see some revenue headwinds, which is currently what they are seeing. And right here where they say, despite retail sales growth, distributor supply chain optimization in the third quarter affected revenue by approximately $124 million. So Celsius is basically saying that if Pepsi was actually normalized and if they weren't holding off ordering more product right now, then Celsius would have had another $124 million in revenue. So that's kind of the situation that is going on over at Celsius right now. But moving on, this says international expansion continued in Australia, New Zealand, and France. So Celsius is continuing to enter new markets around the globe, which is a good thing to see. So now let's move on to the third quarter financial highlights right here. And we can see that revenue came in at $266 million for the quarter, which is down 31% year over year. North American sales are down 33%. International sales are actually up 37%. The gross margin is down 4.4%. Diluted earnings per share are down 100%, and net income looks like it was basically flat on the quarter. And adjusted EBITDA is down 96%. So when you take a look at these numbers right here, these numbers straight up, they're bad. They suck and they're awful. 31% revenue decline. Net income completely dropped to zero. Net income is down 100% and adjusted EBITDA is down 96%, and the gross margin declined by 4.4%. So I do think that Celsius stock does deserve to be down in the market today, because these numbers, like at face value, the headlines just are awful. 30% revenue drop. However, again, Celsius did say that if revenue and optimizations from their distributors were normalized, then they would have had another $124 million in revenue, which would have actually brought revenue to $389 million for the quarter, which would have been growth of about 1% year over year. So on a normalized basis, Celsius did actually grow its revenue by about 1% year over year. But even then, that's not a lot of revenue growth. It's basically no growth on a year over year basis. Moving on through Celsius investor presentation, they show us a couple of different charts on the next slide. So here we can see the actual revenue reported in millions of dollars. And we can see that quarter over quarter, there was a massive revenue drop. And this was the biggest revenue drop that Celsius has seen in its history, I believe. Like, this was a pretty significant drop here. And this is definitely why the market is bearish on the stock today. Now, also, we can see the quarterly revenue over the last 5 quarters in millions of dollars, and then the year-over-year growth rates as well. So last year, in the third quarter of 2023, Celsius had that $385 million in revenue, and revenue grew by over 100% on a year-over-year basis. Then we can see the next quarter was 95% growth, 37% growth, 23% growth, and now negative 31% growth. So Celsius's revenue literally went from growing 100% year over year to declining by 31% year over year. And this is just a massive change. And this is also what I have been warning about on my channel, because you simply cannot grow revenue at 100% consistently. It's absolutely unsustainable. And it's just natural that when businesses grow, the revenue growth rates and the overall growth rates of the business also slow down. Now, I also have to admit that I was not expecting Celsius to see such significant and quick revenue growth slowdown or revenue growth deceleration, but that's just how it played out, I guess. And yeah, that's something that you got to think about when you are investing in these really high growth businesses. It's just that high growth is extremely hard to maintain. All right, but now let's move on to the next screenshot, which shows the market share of Celsius, Red Bull, and Monster. So Red Bull actually has the #1 market share in the energy drink industry at 36.6%, and its market share has actually been increasing over the past couple of quarters by roughly 1%. The second largest company is Monster with 27.5% market share. However, Monster's market share has been steadily declining over the past year now. Then we can see that Celsius has the third largest market share in this industry, and back in the first quarter of 2022, it had 4.6% market share. And then its market share was doubling. It doubled over the next year to 11.2%. However, Celsius market share has now topped out in the first quarter of 2024 at 12.3%, and it is actually losing market share now. This is definitely not amazing to see, especially at the same time as Red Bull is regaining market share. So Celsius does look like it is struggling to continue taking market share from its main competitors, again, which are Monster and Red Bull. So this is kind of turning into a little bit of a headwind for the company because it is now losing market share in the energy drink space. Now, this next screenshot comes from the CEO of Celsius, where he says, "Pronounced supply chain optimization by our largest distributor, which is Pepsi, which we believe has largely stabilized, had an outsized and adverse impact on our operating results during an otherwise solid quarter. We remain focused on our long-term growth strategy of expanding our customer base, broadening our availability, and being the preferred beverage for more occasions. Gross and operating margins in the third quarter fell short due to a significantly reduced orders because of our largest distributor implemented a sizable, successful, and efficient supply chain optimization program in the quarter." Now, how I read this, what a supply chain optimization program is Pepsi simply ordered way too much Celsius product, and now they have to move through all of this product before they can order more product, essentially. That, I think, the supply chain optimization, I think, is kind of just like fancy words for Pepsi is still selling through their inventory, and until they do that, they're not going to order more drinks. That's really what I think is going on here. Now, moving on to the next screenshot, this is Celsius balance sheet. And this is one of the highlights of the company. So right here, we can see that Celsius has cash and cash equivalents of $904 million. Then at the bottom of the balance sheet, we can see that it has total liabilities of $456 million. So Celsius basically has double the amount of cash that it does total liabilities. Or in other words, Celsius could use its existing cash position to pay off all of its liabilities, become a totally debt-free company, and still have roughly $450 million left over. So this is a very, very strong balance sheet, and Celsius is not in any financial stress, and it's not going to be anytime soon. The business is very cashed up. Now, if we move on to the cash flow statement, we can see that stock-based compensation came in at $13.7 million for the first 9 months of the year, and in the first 9 months of the year, operating cash flow has grown to $187.2 million. So stock-based compensation is roughly 8% of operating cash flow, which in my opinion is not insane, and that's actually a green flag for me because it means that management is not overpaying themselves and diluting shareholders to do so. Then we can see that the capital expenditures for the business were about $18 million so far this year. So Celsius has actually produced, what would that be? About $160 million of positive free cash flow and pure profit for the business. So this is a profitable business as well, with a very strong balance sheet, and therefore I do believe that it is not in any financial stress, and it's not going to be, again, anytime soon. All right, so now let's head back over to Stock Unlock, and let's take a look at some of Celsius's key metrics here. So right here, we are taking a look at its total revenue, and we can clearly see that this quarter was a weak quarter for revenue. However, even with that $124 million boost to revenue, if Pepsi actually ordered product this quarter, then revenue still would have been down on a quarter-over-quarter basis and basically flat on a year-over-year basis. So Celsius's overall revenue growth is actually topping out right now, and it seems like the company is facing some serious headwinds. And people were buying this stock because they thought that it was an extremely high growth business. Again, just last year, it was growing at 100% on a year-over-year basis. That has completely changed, and now this business is facing significant headwinds. It looks like the overall energy drink market is seeing its sales decline. It looks like Celsius is also losing market share within that market. So overall, it seems like this business has a lot to overcome, and I'm not entirely sold or confident that Celsius is going to continue stealing massive market share from Red Bull and from Monster. These are very well-established brands and businesses that I don't think are just going to roll over and die and see their market shares taken so easily. So we're going to have to see how this plays out. And you guys can probably tell that I'm not totally sold or convinced on this business. I don't necessarily know if it does have a true moat. And I do think that people were buying this stock with the hope that it was going to become the #1 energy drink in the world. And I'm not entirely convinced that it's going to do that. So you can call me skeptical. I do think that this business has great growth in its history. And I think that it's got a very strong balance sheet. I think its management is actually doing a good job, but I'm just not entirely sold on the future of this business. And for that reason, I'm not personally interested in it too much. But I also think I'm getting ahead of myself right now. So here we're taking a look at its operating cash flow, and we can also see that its operating cash flow has come down in the most recent quarters. It peaked at about $290 million. It's now at about $192 million. So the company's revenue and its cash flows are actually coming down on a trailing 12 months basis. Now, we're also going to go and take a look at Celsius versus Monster. And bear with me here because we are going to do some math to try and find the normalized fair value of Celsius. So allow me to explain my thinking and my rationality for the calculations we're about to do. Well, first off, I just want to show you guys Monster's revenue versus Celsius's revenue, because Monster's revenue in the most recent quarter was kind of flatlining, and Celsius's was actually coming down. So it seems like Monster may actually be outperforming Celsius a little bit in the most recent quarter. But what I want to do is take a look at these two companies' operating cash flow margin, which is right here. And we can see that Monster obviously is a much more well-established brand, and they have consistently maintained a operating cash flow margin of about 21.5%. It's actually been very consistent. Now, what that means is if Celsius becomes a mature business, or when Celsius becomes a mature energy drink business, it could potentially have the same margins as Monster, around that 21% operating cash flow margin. Now, we also learned that Celsius had a $124 million hit to the revenue in the most recent quarter. So on a normalized basis, we can actually add that revenue back to try and get a more realistic picture of how much revenue the business is able to generate right now. So in the trailing 12 months, on a GAAP basis, they have generated $1.37 billion in revenue, which we can enter in right here. So now if we add back that $124 million in revenue that they missed out on this quarter, then it means that in the trailing 12 months, the company would have produced about $1.494 billion in revenue. This is basically $1.5 billion in revenue. Let's just do that to make the calculation simple. And let's multiply this by a 20% operating cash flow margin, which Monster has. It's a mature energy drink business, which means that on Celsius's current revenue, it could potentially produce about $300 million in operating cash flow. Now, I think that this is also kind of realistic because its peak right here was around $300 million in operating cash flow. So I think that this is probably the profit potential of the business as it stands today. So now let's go over to Stock Unlock's discounted cash flow calculator, and we're going to project out Celsius's operating cash flows over the next 5 years at a 15% growth rate and a 25 price to operating cash flow, which is what Monster has historically traded for. So again, this is kind of replicating Monster's price ratio. And if Celsius can maintain a 25 price to operating cash flow and grow at 15% annually, then it could deliver a compounded annual growth rate of 17% from the price of the shares today, or its share price could offer a 17% annual return. However, you do have to keep in mind that this is at a 15% annual growth rate at the same time as the company's current normalized revenue growth is 1%, and it's losing market share, and the energy drink industry is actually seeing a decline right now. So this is pretty bullish in my opinion. And what we can actually do is lower this growth rate down to where the compounded annual growth rate would be about 10%. So for Celsius to produce 10% annual returns from its stock price today, it would have to continue growing operating cash flow at about 8% and also maintain that high-priced operating cash flow of 25. So this is kind of what the market is pricing in today. And if Celsius can deliver this, then it could produce a market average return of 10% annually. Now, as I said earlier, I'm not entirely sold on the future of this business. I have no idea if its growth rates are going to kick back up, or when they will, or if the company is going to continue taking market share from Red Bull. This one is just very far out of my personal circle of competence, so I'm not really interested in adding it to my portfolio at the moment. Well, really just I'm not looking to add it to my portfolio. But these are the metrics that the market is kind of currently pricing in, and that's the level of growth that this business would have to see to actually produce a market-beating result. And that's kind of my logic and my thinking and all the highlights that I found in Celsius' most recent earnings report. So that's me trying to be as objective as I possibly can from the outside looking in at this stock. And I hope that you guys enjoyed this video. Also, if you are someone who is interested in learning more about Celsius stock, then I would strongly suggest downloading that free AI stock analysis report that I generated with Stock Unlocks AI. You can get it for totally free just by clicking the link in the description. Check that out. And also, if you did enjoy this video, please remember to leave a like on it. And if you're new here and you want to stick around and see more content like this, then please consider subscribing to my channel as well. But with all that being said, that is going to wrap up the video for today, everyone. So as always, thank you all so much for tuning in, and I hope to see you all again in my next video.